G'day, expats, and welcome to another episode of Expat Chat. Today, episode 110, and we are going to run through the lessons learned from 2023 and how to kill it in 2024. As always, joined by my mate, colleague, and head of the APAC office, Mr. James Ridley. G'day, mate.
G'day, Brett, and those who are joining us today, joined by mate, friend, colleague, business mentor, all the above, the managing director and founder of Atlas Wealth, Brett Evans, who is currently in the sandpit, and apparently the sandpit's very cold at the moment.
It's nice. Yeah, I'm loving it. I'm loving it. So actually, I was in Riyadh this week earlier, and she was even colder again there. So I didn't actually realise Riyadh is 900 metres above sea level. So it's a very different weather system to the UAE, and it's also not the coast, so they don't have the humidity. So thanks to all the folks who hosted me in Riyadh this week, and clients and Aussies who are looking to engage us. And it's a pleasure to meet you in your lovely neck of the woods.
Oh, yeah, KSA. I mean, when was the last time you were in KSA?
First time. That's it.
First time.
So yeah, watched it from afar. Feels like it's just over the road in the Australian speak, just down the road past the Black Stump. And it's a we do a lot of work with KSA clients and Neom, Daman, Jeddah, Riyadh, all these other projects like Qadiyah, Trojena. Sort of sitting from afar, learning a lot, but nothing beats getting on the ground and breaking bread with folks and having a coffee and really getting into the intricacies of being an expat in KSA, because a lot of similarities to UAE, but a lot of dissimilarities as well at the same time. So we can help clients and Aussies better when we understand more. And it was a good trip, and I'll be back there in the not too distant future. So mate, let's get the show on the road. Let me get a bit of housekeeping out of the way. All the information we're about to have the pleasure of talking to you good folk about should be deemed as educational and informational purposes only. Please do not construe this as financial advice that is personal. If you do need personal financial advice, speak to Atlas.
Absolutely, mate. And I mean, jumping in to today's theme, lessons from 2023, especially, I guess, investment lessons. And I mean, we look at last year and we talk about, everything that was being talked about, yesteryear. I think the main theme was, recession. Are we going to have a recession? Expectations around, is a recession going to happen? The impact that's going to have on share markets long term. And, as we saw, forecasts, they can change very, very quickly. And I think just before we started hitting record on today's episode, we're talking about how the markets all finished up for the 2023 calendar year. Pretty good.
Year. And that's, I think it actually made me reflect on a conversation I had with a new client this time last year who was coming on board. Cash didn't have really any toe in the water when it came to the markets investment-wise. And he's like, did we just sit on the sidelines and to see how this one pans out? And I sort of put him into a virtual headlock and I said, your time frame is 10 years. Whether we go now, 6 months, 12 months, 18 months, to me, you need to play the long game. Yes, there will be volatility this year. There's a lot of talk about hard landings and soft landings. You think we're talking about airlines here. And, I said, to me, we've gone through 2022 with Ukraine and all that was happening there, the fastest increase in interest rates in modern history. And the market absorbed that information because there were known knowns. And I said, even if we eke out, a good 5 to 7% net of fees in a very turbulent market, it's still the first rung on that ladder that you've climbed.
Yeah.
So let's do it. Fast forward 12 months and he did 14.3%. So he's like, glad I did that. But you can talk yourself in and out of situations. And I think people try to be clever. Isn't now the right time? Well, in 10 years' time, when you look back, you're not going to look back whether you invested on the 15th of January or the 22nd of February or the 10th of March. You just, as long as the market's not stupid crazy, which at that point it wasn't, you must execute. You only get runs on the board. You only get rubber on the road when you hit buy. You need to start at some point. As long as you've got a long-term time frame. If it's 12 months, then different story.
Absolutely. And that's the hardest thing, when you're getting all these different forecasts coming from all these economists, if you're only looking at it with a short-term lens, then, naturally you're going to have those different thoughts. Should we invest now or should we just wait? It's like, if you're going to be investing this kind of capital, super as an example, it's invested our whole life, so that doesn't really carry any weight, to be honest. That should just be invested. But yes, if you're investing for only 12 months, probably not. But if you're investing for the next 10 years, you're not going to be looking back in 10 years' time going, shit, should have invested that week before or after. What happens now in 10 years' time, it's probably going to be a mere speck on the overall, annualized return over the whole period. So get in, skin in the game. And I suppose that's a really important lesson from 2023. There was a lot of concern. There was a lot of mixed forecasts, the recession that didn't happen, the most forecasted recession that hasn't happened. And I mean, the way it's trending at the moment might not happen at all, to be honest. I think we might have a soft or a Goldilocks scenario playing out.
And I think it's interesting too. I think people, especially if they're new to investing, especially in the share market, what they need to sort of take on board, which to me is a very important point. And I had this exact conversation earlier this week with a new client in Riyadh. The benefit of shares over, say, property, and look, we love both, so we're not bagging property over shares, but the benefit of shares is that ability to average down or average up on your entry price. When you buy a property, you make money on the way in. If you buy that property at a bad price, you're stuck with that, and you have to hold that for as long as it takes to get a gain out of that property. Whereas if you bought a share portfolio, and let's say you were a bit early, and you wanted to take advantage of any downside in the short term, guess what? Buy more. That'll bring your price down. If you bought something at $200 and it falls down to 150, and you bought the same amount again, then now your average price is 175. So shares are unique in that situation over property. Property has many other benefits as well too. But shares, when people are looking to put money into the market, sometimes you might tranche it in. If you got $1 to spend, put 33 cents in now. Get that toe in the water. Get that exposure. And then you can always add another 33 and another 33, or 33.34 for the data nerds out there. So to me, it's finding that balance and finding that rhythm between everyone, and how that works. You don't have to rush in, but we meet someone every day who is sitting in 100% cash. They've been in 100% cash since COVID. Analysis paralysis. Every article that says buy, they can find two that say sell, and that's doing nothing. But what they've done over the last 4 years has lost out in some very good returns.
Oh yeah, absolutely. And I mean, that's definitely, I guess, the hardest thing, especially the last couple of years. You don't want to be irrational when you're making long-term investment decisions. You want to obviously make those decisions under logic with a long-term horizon. If you have the ability to dollar cost average, that's great. I mean, that's great. You don't have the ability to dollar cost average with property. Can't buy a portion of a property now and a portion of a property later. So
buy a new balcony, yeah.
We'll just slowly build it. Building costs keep going up though. But that's a really important, I guess, takeaway from 2023. Those individuals who entered 2023 with a dollar cost averaging strategy and carried that through the whole year, they would have done really, really well, especially when you look at probably the last 3 or 4 months of the calendar year. That's when you saw, especially the Australian share market, kicked into overdrive. And then even, January, we haven't seen much, to be honest, but that was where most of the performance and that percentage return was put on the board only in the last 4 months. So if you had been dollar cost averaging that, if you missed that, exactly right. If you weren't putting anything else in because you're a bit scared about what's going on, even though you're investing for the next 15 years, then you would have missed it.
And the other one I'd like to segue into, and it's linked, and it's been very topical at the moment, I'm sure, is with you guys in the Australian office, is folks, because they were fearful about recessions and collapses, focus on their mortgages. And I've had to really do education 101 on the benefits, pros and cons of paying off a mortgage, e.g. paying actually off the mortgage or putting money into offset. And I think there's a misnomer out there in terms of if you're paying 7% or 6%, on your interest rates in a mortgage, then yes, you get an effective return that is essentially risk-free as long as you don't default yourself, that you get a 6 or 7% return. However, in the short term, if you're investing in shares at 7% versus offset at 7%, it's great. But as a long-term strategy, the risk with that is when you're getting a 7% return in the share market, it's a 7% compounded return. So you put $100 in, you earn 7%, it's now worth 107. The next year, if you get a 7% return, then it's a 7% return on 107, not on $100. Whereas in mortgages and fixed and offset accounts, you're not getting the compounded return. And look, so you might be sitting there listening to this going, well, it doesn't matter. I'm okay with that. And look, it doesn't matter over 1 or 2 years, 100%, I totally agree with you. But if you look at 5 years of a compounded return at 7%, you're looking at a big, big number compared to sitting in the offset account. So that's the other one too. I think a lot of folks really focus on their offset accounts in 2023 with all Israel going on and the Red Sea and all these things going on that were sort of ballooning, that caused a bit of friction with clients and just, I'm just going to, just put money in offset. Not always the right way to play. Once again, if you are playing that sort of medium to long-term strategy.
Yeah, absolutely. Absolutely. And I mean, when you think about placing money in an offset, we're not really even talking about the impact of inflation on that. And, we're talking about obviously the benefits of compounding, which is great. But yeah, the way the interest rate market is going right now, and I mean, we're talking about inflation, we saw that recent inflation data come out in Australia for December quarter, it was quite cool, to be honest. It's, I think they, spot on, 4.1 at the 12 months mark, December. So we are seeing inflation cool in Australia. I think they'll still have to hold interest rates where they are, probably for the full year, to be honest. I'm mainly worried about probably the commercial property side and all the debt that's sort of hiding in that sector. But I think we'll see inflation on a good track, but I just don't think rates will be cut. But when you think about forecasting and estimates, I think still a lot of strategists will be getting it wrong this year. And that's obviously just one of those lessons we saw. No one is very good at estimating where the market or recession or I suppose inflation's going or interest rates. That's a big one that we all learned last year.
When the data points are moving so quickly, it's hard to throw a dart at a moving train. You're not sure what cabin you're going to hit. And I think it's the same thing right now with, especially last year with the markets where there was no cohesive or concise forecast. There were 20 forecasts. So, part of this might be right, part of this, combine it all together, is what we got. So everyone was right to a certain degree, but they were wrong to a certain degree at the same time. No one got it smashed out. But I think, to me, you can read too much, you can have too much input or from a sensory point of view in terms of what you're doing, and you just go, too hard, I'm going to focus on something else right now. And that's the biggest thing that we see with clients year in, year out is folks sitting on too much cash or just hitting that reset button going, I'm not sure what to do, I'm just going to put the money in offset, and then suddenly they're calling us up saying, I've just got a big tax bill on my rental income. And the funny thing is how they're paying 32.5% on positive cash flow, which that 32.5%, depending on the amount of rental income they've generated, could have wiped out the risk, I guess you could say, of investing their money in shares. So they've gone from the frying pan straight to the fire, when in actual fact the frying pan was cooling as it was, and it wasn't as bad as I thought it was, but the fire was. That's right.
And I think another lesson is, especially through the last couple of years that we've had, everyone's experience, it does take discipline to stay the course, and that applies to investing in any type of risk asset, whether it's shares, whether it's property, whether it's even a business, whether it's, I don't want to say it, but crypto, currency, all those sort of things. It takes time and it takes discipline. At all stages through different investment cycles, all those risk assets, they do go through tough times. That's normal. That's an investment cycle. But it really does take discipline to get ahead and not make decisions based off emotion because of all this data and feedback and news that you're hearing and go, no, zoom out. Hang on, I'm investing for the next 10 years. I won't worry about it.
Stay the course.
It takes discipline.
When I started a few years ago, I think I worked out as 27 or 28 years ago, I had this great saying I've never forgot: wear dentures, buy debentures. And virtually what it's saying is, until you've got the fake teeth and putting that in the glass at night, you shouldn't be sitting in such risk-adverse assets, because your biggest I guess, or your weakest point is, as you say, is inflation and the cost of money over a long period of time. And even when people hit 60, the temptation is to rip the handbrake up and go really risk adverse. But you've now got another 30 years to fund your retirement. It's another career. So if you go too risk adverse and you de-risk the portfolio and you lose out on the growth and you just focus on the income, I guarantee you'll be running out of money in about 15 years' time.
Yeah, absolutely. And I mean, another lesson, and a good lesson that I always love to read from Morningstar, last year's winners are just as likely to be this year's dogs.
Yep.
Which is a really interesting one. Yeah.
And it's a good point. And once again, I had this conversation this week with someone, and I was trying to get them to understand the cyclicality of the market, and different sectors and different businesses do better and worse in different environments. So when interest rates are rising, there's sectors that you should focus on. Utilities, energy, those sort of sectors, they do very well in rising interest rate environments. Whereas in falling, and consumer staples, whereas in falling interest rate environments, and we can see the tea leaves, it's going to happen. I mean, the US Fed was 9% on odds to cut rates in March. That's now down to 60, so that's been pushed out. So let's say that push it out to June. Australia normally follows about 6 months after the US Fed. So Australia's now December, January, well, it might be January because they don't meet, but February next year. You can then preempt and say, well, okay, what sectors do well in a falling rate environment? And then you're looking at property, listed property, you're looking at consumer discretionary, luxury items. There's all that sort of stuff that comes into play as well. So, and it happens at the speed of paint drying. Not talking about day trading one particular stock, but I'm talking from a thematic point of view, looking at themes. And we're not talking about speculating and sort of trying to pick the eyes out of something. We're talking about general themes that you can adjust the portfolio in a very pragmatic way that sort of manages your risk to a certain degree, but also harnesses the opportunity because you're taking a contrarian view. You're positioning your portfolio early, because once it's announced and happened, it's gone. Unless you're either there or you're not. There's no half pregnant. So to me, just sort of keeping your eyes up, and for the folks in the Middle East, it's like driving along the highway at 150 k's an hour here. If you're looking at the front of your bonnet, things are happening very quickly, and you're reactionary. Whereas if you're driving at 150 k's an hour, you're looking at 200 meters down the road. It's no different to driving at 100 k's an hour. You can take everything in. You position and react in advance, as opposed to holding back. Oh shit, all that sort of stuff.
Yeah. And I mean, I've got clients, they are all guilty of recency bias. Oh, these tech stocks just did this. We should buy some.
Yeah.
What? It's like, no. Did you just hear yourself? They've just, done this big run, but now you want to buy them when they're expensive. That doesn't make sense. That sounds like a really stupid investment strategy, to be honest. But we're all guilty of it. Recency bias. We all think it. We all do it. And unfortunately, often a case you might see an index or a specific theme with an index do really, really well for that full calendar year, but then you look at a lot of those tech stocks and how they performed in 2022. Facebook dropped more than 50%. You look at Facebook, the calendar year that's just gone, which had a really good year. But remember, it dropped 50% the year before. So, you really need to be mindful of recency bias. We all do it, whether it's to do with investing or other things in our day-to-day lives. Another good lesson would be diversification. It's always working for you. Sometimes you love it. But sometimes you also hate it. And all that means is you always wish maybe you had a bit more of one little sector, but you're diversified. Yeah. So you're not chasing those quick gains that cause too much volatility and risk within your portfolio. Diversification, it's working for you. Sometimes you love it, sometimes you hate it.
Yeah. I mean, that's the thing. It's easy to say in hindsight, maybe we should have held X stock or X sector or X
we
company.
can all play that game. Come on.
What people need to sort of understand is when you're building a portfolio, and it might be 40 holdings with different ETFs and different markets and different themes, you never get 100% of them all operating at the same time in the same way. No. The aim of the game with investing is that your winners are larger than your losers at a high level. That's it. You're never going to have 100% winners. If you can have more winners than losers, you're making money. If you're having more losers than winners, you're losing money, pure and simple. So it's a matter of making sure that at any one particular point in time, you've always got some winners there that are supporting the losers. And when I say winners, it could be equities, and losers could be bonds. Or it could be bonds are winning, equities are losing. It doesn't matter what it is. It just ensure diversification means that you're well covered. So you've got a foot in each camp, and then year in, year out, you are just generating those returns, even if it's only a 5% return. It's funny how people look sniff at that, go, 5%. But 5% gets you 5% closer to the next one, to the next one, to the next one. And then the next year might be 15%. So now you're averaging out at 10, and there might be 7%. So it goes on from there, but you need to get runs on the board to get that compounding return. If you're not getting the compounding return, you're leaving money on the table.
Yeah. Yeah. And I mean, this is probably a questionable lesson, but I reckon it's always a good one. Not letting your political influence, don't let politics influence your investment decisions. You can let your political perspective influence your vote, but it should not influence your investment decisions. Oh shit, Biden's going to be in again. I don't want to have anything to do with the US, or vice versa. Trump's going to be in. We should unwind our exposure to US. Not a thing. Political views shouldn't sway your investment decisions. They can sway your vote, but not your investment decisions.
To me, it's like you need to be like a sniper, unemotional, ready to pull that trigger. You need to look after you. You need to look after your family. And there will be a time and a place for you to voice your political opinions, and you just trust and all that sort of stuff. And that's, unfortunately what social media has become these days. You feed that. But use social media for that. But in terms of putting money in the bank, providing for your family, keep the two apart. I completely agree. We see this time and time again where people get emotional. You can't be emotional about investing. It is a binary ones and zeros equation. There's no room for subjective narrative when it comes to zigging or zagging.
Yep. Yeah, that's right. Absolutely. And I mean, some really good lessons there around investing for obviously last year, 2023. 2024, it's going to be interesting. We've got a big year ahead of us. We've got a US presidential election. I wonder who we're going to see get up. Tell you what, Trump's gaining momentum, surprisingly.
Those red hats.
I don't know how. I don't know how. I avoid the conversation with clients that are in the US, but they're not usually too political, which is good, but they just shake their heads at it. We've got, I wonder what the budget will hold for us when we obviously wound down and come up to May. There's always going to be some things going on in the background there.
Given the stage 3 tax cut changes, I think this one's going to be a doozy.
Yeah. Oh, geez. I know. I mean, it's going to be interesting. Arbo's pissed off a lot of people with those stage 3 cuts and just the amendment they made.
I know, but he goes to the tennis and does what he wants there. So anyway, mate, let's wrap it up there. For the folks out there, the housekeeping guys, keep the ratings and reviews coming through, please, 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 please. That's all we ask. We don't make this a subscription model. We have to pay to listen to us, prattle on, listen to our dulcet tones. All we ask for is just hit that the 5 stars if you think we're worth it. Subscribe, follow, all the usual banter, mate. And also in the links below, make sure you join our Facebook group, Australian Expat Financial Forum. All the links are below. As always, mate, been a true pleasure and an honour, and we'll catch you on the next week.
No worries, guys. Thanks for tuning in. See you on the next episode.
Thanks, mate. Take care.